Thank you both for being with us. So I'll start with you, Luke. What are you thinking here? This room, still more room to run?
So listen, there's a lot of things to consider with these work from home stocks, and the main thing is valuation. We continue to hear all the time about these extreme valuations, and for a lot of these stocks, it's pricing in that it's basically this work from home mentality is here to stay forever. And the thing is, it's here to stay through 2021. I don't think anybody debates that, but there's a big thing coming up here, and that's the vaccine. And stocks like Zoom, stocks like Slack, they're trading at these valuations, especially Zoom, that like I said, it's here to stay forever. And I don't think that's the case, because I think we're going to return to some sort of normalcy all around. So the stock we like is Microsoft. It's the one-stop shop for everything going on. I've talked about Microsoft before on TD Ameritrade Network and how much I liked it. You got the cloud, you get the gaming, you get the Office 365, and basically Microsoft takes what Zoom and Slack both do and puts it into one, and they have deep pockets. They can continue to invest because they have so much money that it's just sitting in the sidelines right now that they can put to work in different areas.
Yeah, Dominic, what do you think here? I mean, this group certainly has run up. Tell me about some of your favorites, why there may be some more room to run.
So we all know the thesis, right? People are stuck at home, whether it's living or working. They couldn't exit their living rooms, their bedrooms. So it made some sense that some of these companies would benefit from the economy being shut down and the stocks would do very well. But we clearly got to that I'm going to double my money mentality, probably peaking about a month ago. And that was really the time to exit. So we've seen some of these stocks pull back. On the average, the FANGs are down about 10%. Some of these stocks about 20%. So the valuations have become more reasonable, but it's going to be really hard to pick out who the winners are going to be and who the losers are going to be. We're all going to use Skype and Zoom going forward, but are we going to use it as much? And that's going to be very difficult to ascertain which one the winners are and which one of the losers are. So if you have some cash on the sidelines, you can start nibbling here. I would do it through an ETF, maybe the triple Qs, a little bit at a time, but be very careful. Valuations are more reasonable today, but still very elevated.
Yeah, it would have been hard to try and time when to get out, but you make a good point. They have pulled back. Luke, you were looking at some of the names that could be a good buy, but you said don't trade the names that are directly COVID-19 headline driven. Try and pick things that are broader. Microsoft, Zoom, you said that is an everyday habit, whether we get a good or bad headline. Is that your point? And work, that's another one. Would you buy all three?
So Zoom and Slack seem to be trading all the time off of the headlines. And the thing is, when it comes to investing in the stock market, I mean, you have two different time horizons, right? You have the short-term investors, you have long-term investors. If you're looking to day trade and get in and out of positions within a couple of days, it might make sense to maybe trade some Zoom, trade Slack, and stocks like that. But when it comes down to truly investing and getting alpha over time, that's why we like Microsoft. It doesn't necessarily trade just on coronavirus headlines. It's got all this diversification in all kinds of different areas going forward. So we think that Microsoft is something that you know, it's basically you own it, you don't trade it. Same thing that Jim Cramer says about Apple, you own it, don't trade it. And going forward, it's the same story. Microsoft's been around for a very long time, and they continue to capitalize on all kinds of different growth areas going forward. I mean, it was great in the 90s, it's great in the 2000s, it's great right now, and I think it's going to continue to be great going forward. But there are areas you can focus on elsewhere besides, you know, Microsoft, Slack, and Zoom. You can also buy data center REITs. I mean, the thing is, when we talk about this work from home mentality, since it might not be around necessarily forever, and we are going to get back to some normalcy where some companies are coming back to work, you know, in the commercial real estate places, and some companies will remain work from home. The infrastructure build out for tech and cloud still needs to be there. So these data center REITs that are basically supplying the servers or housing the servers that support the infrastructure are going to continue to generate a lot of income over time and a lot of growth. So not only do you get the growth, you get yield on your investment, which is also very important in this low interest rate environment.
Yeah, that makes sense. I see where you're coming from with that. Dominic, what are your thoughts? I mean, are there certain names that you would say you'd be more likely? I know you don't want to be a stock picker per se, but, you know, something like Microsoft, which is more broad-based, or is it Peloton or Zoom?
Big fan of Microsoft. Again, I couldn't agree more. This company's going to be around for another decade and 2 and 3. But we mentioned Apple just a few minutes ago, and you know, at 134, the phone was ringing off the hook. Why don't we buy the stock? We should own it. Today, I think it's at 111. 11 or so and the phone's not ringing, this is a quality company that is going very, very deep pockets. It's going to benefit from the 5G cycle. I don't know if I'd call it a stay-at-home stock, but if you want to own tech, isn't that a great place? Boring as, you know what, look at the transportation stocks, the UPSs, the FedExes that are benefiting and will continue to benefit from this economy turning back to normal. And you can call them, you know, one of the reasons they've gone up so much.
Those are hitting highs today.
All-time highs, but you can see as the economy recovers that they'll continue to do well. So there's a lot of stocks out there that I don't know if I would call them stay-at-home stocks, but will do extremely well as the economy starts to get back on track. And people did learn, oh, I can order my groceries from Amazon now. I don't have to go to the supermarket. So they'll continue to do that. Maybe not as much, but they'll continue to do that, and Amazon will benefit from that. So there are these large cap bang type stocks that will benefit going forward, but trying to throw the dart against the wall and pick out whether Zoom is going to do better than another, it's going to be very difficult. And I think in the end, you're probably going to guess wrong.
Yeah, right. You can't even bother guessing, and that's why a broad-based investment play is probably diversified. Luke, what does the folks at Strategic say over there when they basically are looking at the different sectors? Are there sectors at all that they would just say stay away from?
Listen, tech and healthcare were the best performers recently, and we think they're going to continue to be the best performers going forward. I mean, when we take a look at the current environment and the different asset classes all around, you have to stick with the winners and get rid of your losers. And I think that's so important. I've said this before, and it sounds so simple, but it's the same story. Keep your winners. And the reason I say that is when you take a look at bonds that are paying you essentially zero, the 10 years trading around 70 bips, 0.7%, you have to look at these big names like we mentioned before, like the Apples, the Amazons, the Microsofts of tech that are basically not necessarily risk-free. Don't get me wrong, they definitely are not risk-free, but people are looking for places to put their money, and that's where they're putting it right now, is these big, large names that have been around for a long time and that they think that are going to continue to be around and perform very well over time. So they want that growth over time because bonds that are paying you basically 0% aren't going to generate a lot of alpha on your portfolio over time. So that's something you have to consider as well. Then healthcare going forward, given the COVID pandemic, it's brought a lot of money into the healthcare system, especially from the government side. I think that's going to continue as well. And a lot of these stocks are benefiting, even like Teladoc, these smaller, healthcare names from work from home. That's what we're talking about. Teladoc's a great name that's benefiting from this work from home mentality, this mentality of virtual, seeing your doctors virtually rather than going indoors. And there's a lot to consider when it comes to tech and healthcare. So we think those are the outperformers going forward. It was before, and it's going to continue to perform very well.
Right. Yeah. No, that's great. I mean, you summed it up really well. Dominic, final thoughts here. You said sometimes the phone's ringing off the hook and then sometimes not. You got to be invested, right? Dominic, final thoughts.
We do take risk on and risk off. So we did go risk off about a month ago. So now we're looking at where to redeploy this extra cash. We love healthcare. We've talked about it many times in the past. But look at mid and small cap stocks. They've really been ignored for the most part. People were afraid to put monies into this sector. And again, look where other people are not looking. Mid and small cap, I think, is a great place to start taking some of that excess cash and putting money to work.
Yeah, you're not afraid of the wild volatility we've seen, Dominic, of something like the Russell. Today it's up 2.5%, but it always seems to be the biggest swinger.
Yeah, look, I would, if you have excess cash laying on the sidelines, we do. This is not a time to jump in with both feet. We got an election coming right down the road here. These markets are going to be very, very volatile. So 2.5% of your cash at a time, sector diverse at a time. Don't make the big bet. This would be a big mistake to jump in right now. Wouldn't be surprised me to see the markets lower, maybe 5-10% lower a month from now. But it'll be a great buying opportunity. Keep your dry powder, nibble when you can, definitely jump in, but not with both feet.